Welcome to the quarterly market update for the end of this first quarter of 2023. And what a quarter it's been. Now, I don't have to tell you that the main news in the quarter that hit financial markets was the collapse of Silicon Valley Bank in the US and the contagion that caused with other smaller US banks failing and of course big Credit Suisse over in Europe. Let's have a look at how the Australian market performed throughout the quarter. And to be honest, the quarter kicked off in a cracking way. By the end of January, the market was up by 6.2%. Now, our RBA had their first meeting on Tuesday, February the 7th, where they raised rates by 25 basis points. On March the 7th, the RBA again put up interest rates by 25 basis points, again widely expected. But before the market really had time to think about where we were going with that, on the weekend of March the 11th and 12th, Silicon Valley Bank collapsed. Contagion hit the banking sector throughout the world. It's called a dislocation in the returns between Australia over the quarter and the rest of the developed world, with the banking sector falling pretty much uniformly around markets around the world by as much as 4 or 5% in terms of the sector. It affected Australia more, even though our banks are safer than most other banks around the world. Why did it affect Australia more? Because the banking sector makes up over 30% of our index, where in other markets around the world, that's only about 11 or 12%. Now, there's another reason for this dislocation that's gone on in the quarter. Both the US and Europe, which are the main constituents of the MSCI world, have also done really well in the quarter. And it really comes down to those big tech stocks, the ones that reside in the NASDAQ. Now, that may not be that surprising because you might recall last year the NASDAQ was down by over 30%. There's nearly always a natural bounce back that happens after a market gets clobbered. But the other reason is, as we're getting closer to that terminal rate, the market's getting a better handle on where that might be. And so now they've got a better handle on valuing those stocks. Let's have a look at the bond world. It's been a rough time for bond investors in 2022, and it wasn't looking that great in the early bits of 2023 either. You can see in the chart here, we're plotting out both the Australian 10-year bond yields and the US bond yields, and they were sort of going up as the central banks, both the RBA here and the US Federal Reserve, our job is not done here yet. There's more interest rates to come, and of course that kept pushing yields up. Then, when the banking crisis hit in the middle of March, yields plummeted. In fact, yields plummeted so much that the market was saying we're going to get some rate cuts coming in this year. Now, bond yields are inversely related to the value of your bond portfolio. So as yields go down, the value of the bonds go up. And you can see in the chart here, as we mentioned, it was a bit of a rough time in 2022, with things starting to get a little bit better in the last quarter of 2022. And you can see we've got a nice positive number. That's a bit of a relief going on in the first quarter of 2023. So bonds are now doing their traditional role of playing a safety net against coming economic uncertainty. That wraps it up for this quarter. Thank you for watching, and we'll be back again with another quarterly update in 3 months' time.